Hey y'all, it's Dr. Shamanda. Welcome back to my channel where we talk about all things mental health, personal finance, and overall strategies to live your best life. Alright guys, so welcome back. If you're new here, I am a licensed mental health and addictions therapist here in North Carolina, and I specialize in my practice with helping high achieving women heal their relationship with money, but also with burnout, setting boundaries, things of that sort. Alright, so I am on a 28-day money education challenge. So every day for this month of February, I am posting a video that's 10 minutes or less around a topic around money and mental health. And I know y'all probably hear me. I am stuffy because, yes, I am sick. I got sick. But one thing about me, if I commit to something, I'm going to do it. So here we are, day 18. And today's topic is 3 investing mistakes that are keeping you broke. Okay, so I'm going to be looking at my notes over here just in case if you see me look over, that's what I'm doing. But let's talk about this. So the purpose of these videos, again, is I'm giving you these this education, my insight, but specifically from the perspective of a licensed therapist. So we're focusing on the mental health side of these things as well, right? Now, just so you know, I am not a financial expert. I'm not a financial advisor. I'm not a financial planner, anything like that. I am an expert on mental health, though. I've been doing this for almost 20 years. So let's get into it. The first mistake is investing without a clear strategy. Now, I will say I actually started investing for the first time ever. Well, let me see. I don't want to say ever because I think I invested like in 2017. I added some money to my 401k for my job, but I didn't know what that was. I didn't know. I was just like, oh yeah, I probably should start investing a little bit. I think I was like 28 or something, 27, something like that around that time. But so they don't really count. But the first time I actually started investing was in 2023, right? I think 2023, 4, 5, 6. Yeah, I think it's 2023 is when I first, or 2022. Yeah, one of those. Really actually started investing and taking this very serious because I was like, you in your 30s now, it's time to stop playing. So what I learned was, you need to have a clear strategy. Like, what are you investing for? Because some people think that you only invest for retirement. That's not necessarily the only reason. I know plenty of people who invest because they're trying to buy a house. Maybe they're investing because they want to buy their dream car. Maybe they're investing because they want to start a business. And so instead of putting that money into a high yield savings account, which would be probably the next best option, right? Because it's going to yield you more for your money, give you more bang for your buck, as they say. Some people want to put it in the market to actually see it grow more. So you need to know what your strategy is, like, or what you want to do. So instead of just putting your money into anything, right, or buying some like single stocks, you might want to actually check out the ETFs, right? But then you don't want to just like put them in like random ETFs or like so many different ETFs. You need to actually have a clear strategy of what you're doing and what your goals are. Maybe you don't even have a long-term target. Like if you are investing for retirement, what is the best ETF to put that in, right? I know for me, my 401k, I just kind of went with the Target one, which was located with the year that I would have retired. Like I forgot what they call it, but it's based on like the year you're retired, like based on your age. So you can do that. You also, like I said, buying like random stocks that you see on social media. There are so many people who act like financial experts on social media and they don't have no background, no training. Maybe they have their own personal experience, but sometimes they don't put that as a disclaimer. So you automatically think because they put a screenshot of how their numbers are doing, basically, then they're doing something right. But that is not necessarily the case. Okay, so mistake number 1 is just investing without having a clear strategy. Okay, now what that will do to your mental health is obviously you're gonna probably have a lot of financial anxiety around that. You're gonna be second guessing yourself, and just a lot of stress that really doesn't even have to be there if you would take your time and really kind of plan it out and have a strategy. That is where I would definitely recommend having a financial advisor. You know what I mean? Because it's like, you don't know what you're doing. We don't expect you to know what you're doing. Go ask somebody who who knows what's going on in the market. All right, mistake number two is emotional investing, right? And that means that you are like constantly checking the numbers, checking the market, right? And as we all know, if you're invested in any way, there's constantly dips, right? And if you are emotionally investing, you're constantly responding to those dips. You might be like, oh my God, like what happened? Because every day it could dip. You can see all that red and you're just like, oh my God, let me pull my money out of here because what's going on, right? It could also lead you to actually selling during a dip, which is going to cause you to take a loss. There's one saying in the market, correct me in the comments if I'm wrong or if you know it a different way, but it's basically like it's not a loss until you sell it. So like, for example, if you had $3,000 in your in your Roth or something, right? And you saw that it was down by like 500 that day. And then all of a sudden you get scared and you sell that stock. Now you've taken a loss versus if you just keep it there, more than likely it's going to go back up. And then if you want to still sell it, now you're selling it at a higher rate. So you just make sure that you're not responding emotionally, right? The opposite of that would be like buying during a hype. So maybe there's a hyped up business or something going on, and so you're just like buying a lot during that time, but that could be inflated, right? Because maybe something happens in the next couple weeks or whatever, and you bought all this stock and now they did something and everybody's turning against them, and like now it's a low, right? So and also like panicking during all of this, right? So that is the emotional side of investing. So what I would suggest is just understanding that the markets fluctuate daily. There's no constant. Like, it's going to be up and down. So just knowing that. And then also committing to investing long term and being consistent, right? And time in the market beats timing the market. That's a saying too. All right, number 3 is that when we ignore tax advantage accounts, like the Roth IRAs, and so not opening a Roth IRA, and investing only in like the 401k and 457b. I'm gonna tell you that Roth, like knowing that like it's already taxed, like knowing that when I pull that money out, I don't have to worry about, oh, I gotta get the taxes or whatever. Like that is such a relief, and so if you have the opportunity to actually contribute to your 401k, whether you work a job or not, right? Because you could do a solo 401k, which that's what my next video is going to be about as someone who's transitioning to entrepreneurship. But if you can also contribute to a Roth, it is going to be so much more beneficial to you as well. And I'll do another video if you want me to break that down as well, because I didn't start investing into a Roth until the year after I actually started investing, I think like 2023. And I maxed out 2024, 2025. Yeah, that's right. And this would have been my 3rd year max now, which is there's still hope for that. So just knowing that there's so many options to invest and you don't want to leave anything on the table. So if you can do a tax advantage in contribution, definitely take advantage of that. Okay, so that is why, right? So you don't build wealth by reacting. We build wealth by structuring. And there are many mistakes that we can make when we're investing. And nobody's expecting you to be perfect. At the end of the day, it's about just getting into the market, right? Doing what you need to do. Doing some research, studying, following people who actually know what they're doing, who are actually certified and experienced at this, right? You don't want to just be following anybody and taking their advice. You need to know what your goals are. What's your long-term strategy? Are you focused on retirement money, or you focused on, okay, I want to build this money up so that I can reinvest it in something else? Should I put it in a savings account, or should I put it into the market? How soon will I need it? Is there a dip going on? Is there a hype right now? Just really understanding those components, right? Now, I'm offering a membership right now. It's live and active, where we're going to be talking about stuff like this, like on the real, like our mindset around it, different strategies. I'm not an expert, but I'm someone just like you, and I want us to grow our wealth together, okay? So check that out. The link is in the description. Also, I'm offering one-on-ones if you want some coaching as well. All right, I will see you guys in the video for day 19. All right, see you soon. Bye.